Hey guys, Matt here. So in this video, I want to go over my weekly portfolio update, and then I want to talk about why I prefer investing in stocks over ETFs. So this is my portfolio. If you're new to my channel, you will note that I don't really stick to one type of investing. I'm not a growth investor. I'm not a dividend investor. I'm not a value investor. Right now, my goal is to just invest in great companies. That's my goal. You will see I do have an ETF, but most of the stocks in my portfolio are, of course, actively picked stocks. Now I talk about Gevo and Hyliion in every single video, but so I'm just gonna go over them briefly right now. Gevo, I'm actually positive. I'm actually making money in Gevo right now. Now I think not last Thursday, but the Thursday before, I think. Gevo had like a 40% gain due to a partnership with Chevron, I think. And then after that, it sort of went down. Now, thankfully, it didn't go all the way down, like $5. It seems to be holding its own around, the mid sixes. So I'm happy with that. Hyliion is, inching its way up, I guess. Like, it'll be like later this year or beginning of next year before we see something substantial that will turn the tide, like them announcing revenue. We'll see how that goes. Now, these two stocks have been weighing down my portfolio for some time. This time, well, except for Gevo recently. But, I mean, they're not the only things weighing my portfolio down. We also got FedEx, which I think 3 or 4 months ago was pushing 300, and now is down to $255. Now, in my opinion, that's probably due to the whole Delta variant sort of wreaking havoc on the road and the whole supply chain disruption. They do have earnings coming up Tuesday. Now, this is one of my higher conviction stocks. If this thing drops below my cost basis considerably, I will put money into this. I will start investing in shares in this. No ifs, ands, or buts. Most definitely. We got Revolve inching its way up back into the 400% gains. That's a 5xing my money. So hopefully it'll worm its way there. Tapestry has been tapered down a little bit, seemingly for no reason, despite fantastic earnings. Now, I don't know if I'm going to add more to this or not. It's still way above my cost basis, but I'm thinking about it, but we'll have to see. We got AT&T. I've been adding shares of AT&T for Verizon this week. You'll see that in a second. But, I mean, I don't know. AT&T has a habit of, just seeing a situation and look at it and just, going, you know what? Things are going way too well. Let's fuck it up. But, I mean, that being said, I do believe in AT&T in the long run, and so that's why I continue to invest in shares. And in the next couple of years, I think I'll be happy that I did that. And that puts my portfolio at $59,983.81. We're sitting at a gain of 31.23%. We keep going above 60, we keep going below 60. That seems to be the name of the game right now as far as my portfolio is concerned. As far as the moves I made, my put I sold on Gevo just expired, so that means I get to keep all that $86 to myself. I bought some Verizon, I bought some more Verizon, bought some AT&T, bought some more AT&T, and that's it for this week. I received some nice dividends from Walgreens, and I received my monthly dividend from Realty. Now let's talk about my performance versus the S&P 500, and this is what's going to segue into the main topic of today. We're looking at a 1 month gain of 0.44% versus the S&P of 3.04%. 3 months of, I'm doing terrible. I'm doing absolutely terrible. My 1 year is doing fantastic because last year was great. I absolutely crushed the S&P 500 this year, but this year we had a few stocks that, aren't doing so well this year, and you can blame it to the supply shortage. You can blame it on the Delta variant. You can blame it on a lot of things, but the fact of the matter is that the S&P 500 is kicking my ass. And that's what got me thinking about the whole stocks versus ETF thing. Like, on January 1st of this year, I could have sold all my stocks, just everything I had, put all my money into an ETF tracking the S&P 500, and I could be doing better, much better than I am right now. So yeah, which do I like better, ETFs versus stocks? Now, I'm gonna come right out of the gate and say that ETFs, in my opinion, are the best way to invest for most people, and maybe me. I mean, with ETFs, now in this video, we're gonna focus on the ETFs tracking the S&P 500 and the ETFs tracking the stock market as a whole. There are many different ETFs out there, I know, but in this video, we're gonna focus on those too. But I'm gonna come right out of the gate and say that ETFs are the best way to invest for most people. Absolutely. You don't have to research stocks. You have to research anything. All you have to do is open a brokerage, pick the S&P 500 ETF of your choice, whether it be with Vanguard, with Fidelity, whatever. Throw in a set amount of money in each month blindly, and you will do very well over the long term. Or would you? Let's take a look at some charts. So over the past year, the S&P 500 averaged in return 35.1%. Now, if you take a look at some of my stocks, like I have stocks that have crushed that. I have stocks that have crushed that 4 or 5 times over. And I also have stocks that didn't. So I could have put all my money into, say, Revolve if I had a crystal ball, and I'd be doing much better than S&P 500. I mean, S&P 500 only returned 35%. Which brings me to one of my points is that potentially, if luck and perseverance is on your side and you invest in great companies, you have the potential to make much, much more money than the S&P 500. I mean, if we take a look at my investment here, like over the past year, yes, I did beat the S&P 500. Over the past 5 years at S&P 500, you made 104%. I haven't been investing in 5 years, so we'll have to come back to this in 2 or 3 more years to see how exactly I, measure up. There's another thing I want to show you. Let's take a look at the S&P 500 as a whole. Now, hopefully I do this right this time. Now, let's say you invest in 2000. This was your time to invest. You click here. It would be, let's see, it would be 7 years before you made any money. That depends on when you start investing, how long you plan on investing for, how old you are. Because, if you invested right here, yeah, you'd be doing fine. But if you invested here, we're talking 7 years before you made any money. And then guess what? Before you lose it all again, and before you started hitting it big, we're talking 13 years before you really start kicking ass. Now, from those 13 years, if you invested more recently, yeah, the sky is the limit. And taking an ETF that tracks the total stock market, let's say you invested in 2007, because the economy is doing great, stocks are doing great, stocks only go up, right? So you invest here, it would be, I think, 2013 before you made any profit at all, and it would be 2014, so 7 years before you made any real money. So what I'm trying to say is with ETFs, yes, it is much simpler to invest. You don't have to think about it. Just put a set amount of money in each month, and over a long-term span, you will make some money, and some considerable money at that. But it also depends on when you start to invest, because depending on the time period, it could be a while before you see that money, before you see that considerable money. With actively picked stocks, you have the potential to make a lot more money. You also have the potential to lose a lot more money too. But, not if you invest in great companies over the long term. And that's what I choose to do. I want to make money over the long term. I've waited too long before I started, seriously investing. I'm going to be 40 in November. So, I mean, I'm way late to the game. If I was in my 20s, yeah, ETFs would be a good way to, to snowball my money. But nowadays, I got to get a head start. So I'm going to invest in, invest in great companies, and hopefully, if I do well, make a lot more money in the long term. And another reason, going beyond the strictly financial aspect of it, is I enjoy the act of actively picking stocks. I enjoy doing all the research. I enjoy, hopping on earnings calls. I enjoy looking up and investing in companies that I think are fantastic. I think the stock market is one of the greatest gifts of capitalism, because just think about it. If a company does well over the long term, we're not talking the short term. In the short term, anything can happen. But if a company does well over the long term and you're invested in it, you will do well over the long term. If a company doesn't do well over the long term, then you will probably not do well over the long term. Now, it's true that the same can be said of ETFs tracking the S&P 500, because yeah, if the S&P 500 does well over the long term, you will do well as well. If the stock market as a whole does well over the long term, if you invest in the VTI, you will do well over the long term as well. But I mean, what I want to say to that is, this is a completely personal thing, but I have to like what I do in the interest of making money. Sure, we're all making money at the end, but personally, I have to like what I do. My first job, I am a network engineer, and I make pretty decent money. However, I know I can make a lot more money if I go into sales, but I don't want to go into sales because I wouldn't like what I do. I like working with firewalls and routers and switches and computers and stuff like that. So to sum things up, yes, ETFs are more guaranteed to make money over the long term, a considerable amount. However, I prefer, actively investing in stocks because the potential is there to make a lot more money. And if you don't invest in shitty penny stocks, if you actually put in the work to invest in, research great companies and find these great companies and invest in them over the long term, I think that anyone could make more money than S&P 500. But anyways, take care, have a great day, and eat your vegetables.